Welcome back to our channel. My name is Aldo Agruta and I'm the founder of the Technical Analysis Institute. We're dedicated to helping traders start and sustain profitable trading careers without the frustrations and losses that are typically involved in the process. Today we're going to dive into a topic that can make or break your trading success. I'm referring to divergences. Are they really profitable? Are they really tradable? By the end of this video, you will discover a powerful technique to optimize your divergence trading for maximum gains. So stay tuned, because what you're going to learn in this video has the power to truly transform your trading journey. In this video, we're going to look at divergences. Are they really effective? And can we improve them? We're going to see the anatomy of a trade using divergences the traditional way and how it works on our psychology. This is a 30-minute chart of the Canadian dollar. We can see prices made a first high at 140.65 and a higher high at 141.21. The RSI did not go higher on the second high, producing divergence. In other words, prices went up and the indicator, which is based on the price, did not. Notice that there were 5 bars between the first and the second high. Most courses on the RSI will say that a 5-period divergence, in other words, a divergence separated by 5 bars, is supposed to be the best and most effective one. With that in mind, it's natural to assume that when we see a divergence separated by 5 bars, we have the most effective bearish divergence signal. So we get excited at the opportunity in front of us and we sell on the close of the last bar. That is exactly when the RSI showed it was going down. Before the close, we don't really know where the RSI is going to end up, and that is worth remembering. Always wait for the close before you can even start thinking of a potential divergence. So let's say we sold at 140.83 and placed our stop at 141.22. That's 1 pip above the high, around 40 pips of risk. The next bar opened at the exact price we sold and went up all the way up to 141.15. Now we're suffering, but at least we didn't get stopped out, so it's all okay. The bar closes on the low, which is a great sign that the bears are in control and the RSI continue going lower. So at this time, we are relieved from that scare and we start feeling excited about the trade. We probably think 5-period divergences are so good. And while we are already calculating all our gains and patting ourselves on the back, the next bar opens on the low and closes on the high. Prices go above our place of entry, and for a moment we go negative again. That would likely generate doubts in the position. Should I have taken this position? What should I do now? Should I exit it? What if I exit it and then prices move in my direction? And before we are even able to take a decision, the next bar takes us out of the trade. We are stopped out, we're sad, disappointed, frustrated. We say 5-period divergences are not such good signals after all, or worse yet, we think the RSI doesn't work at all. Those negative thoughts may even trigger and invite more negative thoughts. It's all a trap. There is no way to win in this business. Markets are manipulated, indicators lie, and while we are crying inside and complaining, we take a quick look at the RSI and notice that it's even lower than it was before we entered. So there is a second divergence. If the first one didn't work, the second one surely will. Obviously, momentum is weakening, so this market is bound to fall. So we sell again on the close of the bar at 141.03 with stop above the high, which this time is 141.26. Just a 23 pip stop, even better than before. In fact, half the risk from the previous trade. As we see the second divergence, we think that the previous trade was stopped out for no reason. We believe that Had we just put the stop a bit higher at, let's say, 141.30, we would have not been stopped out uselessly. So this time we decide to use a larger stop because we are only risking 23 pips. Instead of placing the stop 1 pip above the high, we say let's give it more room to breathe. Let's place the stop at 141.30 this time. After all, this trade has a lot more probabilities to work because it is the second divergence and it has only 27 pips stop. The next bar scares us again. It goes all the way to 141.19. Thank God we gave it more room. And before we finish rejoicing in our inspiration to have a larger stop, the next bar goes up to 141.32 and stops us out again. So much for double divergences. Our frustration at this point is indescribable. On the first trade, we lost 43 pips. On the second trade, we lost another 27 pips and we are now 70 pips in the hole. We start thinking, why are we using this stupid indicator? Haven't we heard of the CCL or CCI, the stochastic, the MACD, or the whatever invoke indicator is out there? In fact, we remember about this guy who can teach us about price interpretation and naked charts. He says that indicators lie, and obviously he's right. It's only $30,000 for the weekend course in Las Vegas, but we should consider buying that program so we never have to rely on indicators again. We think something like that, and all these ridiculous offers that marketers make start making sense for us. But wait, do you see where the RSI is now? It is actually even lower than it was before, while prices have made 2 new highs. That is a triple divergence, and it is about impossible that this one won't work. This is our opportunity to recover our 70 pips loss, and this time it's a triple divergence. Those, according to many experts and courses, have even higher probabilities to work. Remember, I am trying to recreate a situation and our thinking process during that situation, at least the thinking process of a great number of traders who go through the same issues trying to buy or sell divergences. So we think, let's sell again. But this time, since the odds are truly in our favor, let's double our size. And again, we try our luck with divergences in the hope that we will recover all our losses and end the day positive. We sell at 141.25, which was the close of this bar and which confirms that the RSI is lower. Our stop is above the top at 141.32, and this time we learned our lesson. It is better to use 1 pip above the top to place our stop. Otherwise, we can be stopped out with a larger loss than we need to, like we did in the last trade. And this time we were correct. Triple divergences are super cool. Look at the next bar after we entered our position. It's coming down rapidly. We'll surely get out of the hole we dug in the last 2 trades. The RSI continues moving lower and our odds are increasing. At least we believe that that is the case. The next 2 bars confirm that we took the best decision ever and we're going to make so much money on this trade. We regret we only doubled our size. We should have tripled or quadrupled it. That was so stupid of us. We had learned that triple divergences always work. Why on earth didn't we trust our gut feeling and knowledge of multiple divergences, we think? So we go frustrated anyway, even though we are now on a winning position. And then our frustration makes us think, why don't we add? Look, the bar closed on the low. The bears are in charge, as we thought they would, so we add another position at 140.48. But we won't make the same mistake as before. This time we triple our size, so we can capitalize on this winning position, recover all our previous losses, and then gain some. We'll show our partners, our friends and spouses that we can really trade. And look at the next bar. just as we added, the next bar goes straight against us. Typical, isn't it? The story of my life, we say. But that's okay. After all, markets don't move straight in one direction. We'll be okay. The RSI is still going down. The next 4 bars continue going against us. Now we regret to have added. We really turned sugar into poison and are now in the hole again, a much bigger one. But this could be just a retracement. In just one trade, we moved from frustration to total confidence, from overconfidence to defeat, then fear, and now hope. We are hoping it will change direction and start to fall again soon. The next 2 bars give us a relief. It's starting to fall again. We'll be okay. At least that's what our hope tells us. And just few bars later, we are stopped out again. This time with a much larger loss than the previous 2 trades. That's the real story of what happens when we try to sell bearish divergences. They can go on forever. And that's what they do to our psychology. In fact, you can see how on this new high, the RSI is still much lower than on the previous 3 highs. So we could continue on this trap for some time, selling bearish divergences and losing multiple times. On this chart, you can see that had we sold this 4th divergence again, we would have been stopped out again. Prices made a new high. So the reality is that selling bearish divergences is an absolute losing proposition. And you want to know why? The answer to this will really blow your mind. But I hope you remember it forever, because it will save you lots of pain, money and frustration. The answer is that bearish divergences only occur in uptrends and bullish divergences only occur in downtrends. What? I know, that's such a horrible statement. Yet, it explains why you have been losing so much money every time you try to sell a bearish divergence or buy a bullish divergence. In the example I just gave you, had you used a simple trend line, you would have seen that the market was in a clear uptrend. Notice how that trend line held prices after the 4th divergence. Isn't that revealing? A trend doesn't change until a trend line is broken. I hope you never forget that. Now, back to our divergences. Let's talk about how to improve them. If bearish divergences occur only on bull markets, is there a time when we can indeed sell a bearish divergence? In other words, wouldn't a top be accompanied by a bearish divergence right before a trend change? And the answer is, tops are not always accompanied by bearish divergences on the RSI. But there is a way to sell bearish divergences in a way that we have much larger odds to have captured a top. What's that magical way to look into the future? Well, there is no magic at all. It is just a simple rule that will help us sell or buy divergences when the odds are on our side. What is that rule? You have it in front of you. If the first RSI top is above the upper reference line and the second RSI top is below it, odds are that that bearish divergence forecasts a change in trend or a much larger decline. This is the same chart. I just marked the tops of the RSI with arrows and their corresponding prices. Notice how the first top was way above the upper reference line. It was not just above the 70, but it went all the way to 88. While the second top on the RSI, which corresponds to the highest bar in price, was under the 70 reference line. Consider the difference. Had we sold the close of that bar at 141.61, we would have seen at least 150 pips decline. That's how selling bearish divergences at the proper time do pay well. but you need to be patient to wait for that condition to appear. On the internet, there are 5,000 and 7,000 RSI courses that will tell you that you can sell bearish divergences if they are separated by 5 bars. Well, you have seen in this example the exact opposite. Keep the rule I just gave you, and you will put money in your pocket while saving lots of frustration and pain. Now I know you are thinking, do those divergences occur often enough, or was that just a rare example I found after several months of search? And the answer is, this is not a strategy that you will use every single day if you are day trading. But whenever you encounter it, you'll likely put money in your pocket. I'm not saying the strategy is infallible. That would be ridiculous. It does fail, and I will show you one on the next chart. Otherwise, I would be misleading you like everyone else in the industry. But I must confess that in all honesty, finding a good one took me less than 5 minutes. But I did have a hard time to find a failing one for this video. Here is an example of 2 valid bearish divergence signals, where one failed and the other succeeded. The first arrow shows you a high on price and the RSI top is above the upper reference line. The second high shows the RSI top under the 70 reference line, while prices are still higher. Yet, this signal was a failed signal. The next high shows again the RSI above the 70 line and the next high with the RSI below the 70 line, and that signal was a super profitable one. Both signals were valid, but one was a small loser while the next one was a huge winner. This is a daily chart, and that signal would have been worth more than $10,000 with just one standard lot. Could we have avoided that loser? In other words, is there any way to refine this rule even further so we can filter out the bad signals, as in this chart? And again, the answer is a resounding yes. And it would involve a confirmation for the RSI that typically results in a breakout trade. The technique requires that in a bearish divergence, the RSI low in between the 2 tops be penetrated. So the low between the first RSI top above the 70 and the second RSI top below the 70 should be violated, and its penetration is the signal. This is the same chart, but I added a bit more information. In the first case, you can see I marked the RSI low in between the RSI tops with a pointing down arrow. Now, notice that that low was not violated before prices continued higher. In the second case, you can see that the RSI low between the 2 RSI tops, which I also marked with a pointing down arrow, was indeed penetrated, where I marked it as breakout confirmation. I also drew a vertical line so you can see the exact bar where the signal confirmation was given with the corresponding entry short on price. Look at the phenomenal trade that signal gave. As I said, it was worth more than $10,000 with this simple strategy. And notice how we could have saved the first loss by simply adding this confirmation rule. Indeed, it requires discipline and patience, but that is common to every winning strategy. Again, the most common question I always get whenever I teach a trading strategy is, does it work on a small time frame? So my answer is always, any strategy that is good will apply equally to all time frames. Here is a 5-minute chart of gold where you can see a valid bullish divergence followed by an also valid bearish divergence. I believe this answers the question of how often you can find these signals. This particular example shows you how within 2 hours of trading you could encounter 2 valid RSI divergences signals, one to buy and one to sell. On the first one, you can see how the RSI went below the lower reference line, and the second RSI low, which was a lower low in price, was not accompanied by a lower low in the RSI. Instead, the RSI found support above this 30 reference line. That signal was good for more than 60 ticks, or perhaps a bit less if you waited for the confirmation breakout that we just spoke about. The second signal was a bearish divergence where the first high of the RSI was above the upper reference line and the next high in price had the RSI below the reference line. That signal was good for another 70 ticks or a bit less if waited for the breakout confirmation. Not bad for 2 hours of trading just with this rather simple strategy. Why is it that this rule works better? Very simple. It's explained best using the Elliott wave principle. Third waves are typically accompanied by the RSI moving beyond the reference line, and the fifth waves typically end before the reference line. Thus, a divergence where the first high is above the reference line and the second high is below the reference line correspond to the top of the third and the top of the fifth wave respectively. In a downtrend, the third wave would move below the reference line and the fifth will stop above it. That will produce a divergence with a lot more probabilities to succeed.